Hello there, and welcome to discussion of really a subject that should get you truly excited, more than any political things that are going on in the world or anything else. And that subject is, how do we adjust the WACC, the weighted average cost of capital formula, for tax shields on interest? Now, if you're like me, which I doubt you are, you've been bothered by this for a long time. And in the Google Drive, if you get the Google Drive, I put this thing, Chapter 2, in the Google Drive. And on this Chapter 2, I have some project finance articles and documents, and I have value of money articles and documents, and valuation analysis, and credit analysis, where I put a lot of, these are just stuff you get from the internet. So, you know, these are nothing, no Excel files, just articles. Now, if you go to the valuation analysis, I have some articles, oops, wrong one. I have some articles on the, whoops, no, I'm going to the wrong one. Some articles on the adjusted present value method, and some man named, who is this? Luhrmann. He said you have to, he says you have to use the APV, and if you don't use that, you're out of touch and you're obsolete, and using the WACC is completely obsolete. There are a couple of other articles like that. I'm going to show you that this is totally a bunch of rubbish. And if you look at keep looking at the valuation analysis, then I put all these articles about the interest tax shield. Which one should we take? Perhaps valuing the tax shield. And this is very typical of one of the articles. They go through an executive summary. Oh, this is probably not the one I want. And then start putting some formulas. And then you start getting crazy with these formulas. And at the end of the day, I'm going through it quickly, actually. This is typical when I make a video. I click the wrong one. Let's click these one. I think this is by the same authors. Ah, damn. Sorry about that. I didn't mean to say anything. This is, okay, let's look at this one. Okay, this is a little bit better one. They talk about these other methods, and they go on for pages and pages with formulas, and kindly don't give you a real conclusion to anything. They don't even tell you kind of how to do this. And the issue is, if you're in a place with no taxes, then you should switch off the video immediately, unless you want to go through the theory and see how to work out things. This should not be that difficult a subject. This should not be some controversial subject where you don't really know an answer and where you use all sorts of different methods. Now, what I have done, and here's kind of my theory on this, is this has got the circular effects of valuation. Now, what I'm going to do is make a series of videos like this that work through tax effects of the WACC, and I don't know, target capital structures, how to compute the beta on debt, all sorts of very practical issues about applying the weighted average cost of capital. I'm going to make a little course on it, and blah, blah, blah. Now, here is my general point. The basic point is you can use the WACC like you always do, and we're going to prove it. And with these WACC kind of formulas, proving it is the big deal. And it's not nearly as bad as you think. And the only thing you have to be really careful is when you do this whole business of ungearing or unlevering and relevering the beta. And when you relever the beta, you have to use a a capital structure that reflects the fact that when you have an interest deduction for debt, the essential market value of that debt goes down. We'll talk about it. The true interest payments, your obligations, your fixed obligations go down. It's nothing different. Putting a tax reduction or a tax deduction on interest is nothing much different than just saying, okay, there's a tax deduction. And don't, here, please, 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 don't get confused about personal taxes or anything like that. That's crap. Everything done, all the betas, all the EMRP, the equity market risk premium, the risk-free rate, everything is pre-tax. Don't start saying, oh, we can deduct dividends and all that. That's irrelevant. That comes from another one. And then I'm going to prove to you that how the cost, I'm going to demonstrate the whole thing by a really simple example. And then we're going to take that example and demonstrate that, you know, to keep an unbiased formula, you have to make some adjustments. It was more complicated than I thought it would, to be frank with you. Now, if you see the beta on equity, which you get from the stock prices, and we can get the beta on debt, that's another separate video I just already told you, and the circularity created by all this stuff, that's going to be a third or fourth video. There's no need for any APV or anything. It doesn't add anything. It's a bunch of rubbish. It really, really is, once you understand a fundamental point. And here's the really big point. You have to know something about the formulas and why they're there instead of just putting them in there. Okay, so that's the one I really want to emphasize. Okay, now, I'm going to start this. Pretend you have a house and it's valued. It's got a market value of $100,000. That market value when somebody buys or sells a house has nothing to do with the loan. Everybody agrees with that. That's Modigliani and Miller, who I really do respect. I met Miller a few times. He's a good guy. He's dead, of course, like I will be soon. Now let's say you have some debt for the house, and the debt has an interest rate of 10%. Now, somebody, I'm going to pretend it's in perpetuity, so we just take this. If we have $6,000 of interest, the market value of that debt is $60,000. There's the market value. Now, if you sell the house, you're going to get your $100,000, and then pretend you have to go and get rid of that debt, and pretend that debt has some value on some market. It's traded debt. You would have to go and buy back that debt. Let's pretend that's what you have to do, and then you get $40,000 net. Now let's say somebody comes along and gives you a new loan, and for some reason the cost of debt in the economy is still 6%, but they give you some break. They just say, I want to be nice to you because you're a special person and you're going to get 60, that's like a 40% tax rate. That's like we get a deduction for the debt. Now if you take that interest reduction and now the market value of that debt, remember we're going to use the pre-tax cost to value everything, that's not changed. It's not changed. We just take a reduction. Now the value goes up, and the value went up by the change in the debt. That's all it did. The change in the debt here makes the value go up, and that's what should happen in the whole financial model. Okay? Now, here is the fundamental idea. I think I have to keep track of 8 minutes already, because I need to do some calculations here. Now, let's make another example. Now, when I make this example, let me see. If I press Shift-Control-R, Shift-Control-E, I'm going to start with a case that we had no taxes. That's like starting with this house before we get an interest reduction. And then I'm going to say, well, I don't have to get into too much theory on this. The government comes in and makes a tax. Oh, everybody's bad, everybody's sad, of course, but we have some kind of economy where everybody's prices go up and the economy goes up, and you're left with companies that have debt having a comparative advantage. And the debt is suddenly worth more to them. So for some reason, if the value of the assets is the same, the cost of the debt goes down, making the value of the company essentially increase. Okay? Now, if we applied the weighted average cost of capital, here's what we do. We look into the balance sheet, and we compute the value of the debt. You should use market value. Everybody knows that, I assume. Okay. And when we compute the market value of the debt, Shift Control E, that's just a macro I made, and I put it in that generic macro, so this assumes you have generic macros open. Okay, so here what we do is we keep the value of the debt, we don't do anything like this where we pretended the debt value goes down. No, we don't do that. We leave the nominal value of the debt on the balance sheet. The equity, the value goes up of the equity because, just like this, we get net proceeds. Our value goes up when the debt goes down. So I made the same sort of assumption. You could argue with me, and you can read, I've written something up on that. You know, we can talk about exactly what happens if you'd really implement a tax rate. But basically I'm saying, okay, pre-tax, if everybody's all equity, you still get this value. Now if you're debt, you get an increase in your value. Okay, now we could do another thing. We could say, okay, I'm saying too much. Sorry about that. Okay, the value of we're going to put the value of the debt lower, just like we did here. And then we're going to recognize that in valuation, you generally use pre-tax numbers. Sorry about that's what you do. This BE, the equity beta, that doesn't measure if there's a dividend exemption or a capital gain or anything else. It just says, here's the cost of equity. If there's some change in the personal tax rate, the pre-tax cost of equity you observe changes. Okay, I just want to make that point very clear. All right, so the true, correct way to do this is to kind of say, all right, well, let's give the benefit to the debt, and let's increase the value of the equity and leave the overall cost of the value to the firm the same. That's what really happens. And I call this the net, I'm going to write it down, this is the net of tax, I'm going to switch it to English, net of tax capital structure. And this is the gross capital structure. Okay, oh, I can't spell it and you don't care, do you? Okay, am I being perky enough today? I hope so. Now let's pretend we have some things. Let me tell you, I've got to do a little bit of Excel. I'm going to make a 300-line model. Please, if you put one of the best shortcuts is Alt-EIS and then go to 300 and press enter. And the reason that's such a good shortcut, it's such a wonderful thing to do together with the Shift Control R. So I just made it. So this is just I just said, okay, let's take this cost times 1,000 for 300 years. Delete this. Now, once you've done this, you just put an equal sign, go back to that one, Shift Control R, and as long as the generic macros are in there, it's there. And I'm terrified that Microsoft next time will have Shift Control R in their Excel. I just don't understand why they don't. Now, if you look at the different valuations, if we just say, okay, we had no taxes, so I'm going to start with this capital structure. We have debt and equity. And I just made an assumption, by the way, put some RF, RM, risk-free, equity market risk premium. 4% is enormous. I'm going to say why I believe that. Okay, BD, data on debt is nothing like this. If you have a credit spread of 2% on a triple B bond, then the credit spread implies, and that's over and above the risk-free rate, obviously, that's what a credit spread is, that implies a beta of 0.5. It's just half. You can get the beta from credit spreads. Why in the heck nobody gets the real beta on debt when it's about the easiest, most objective thing to get is beyond me. It's really beyond me. Right? And it changes the results dramatically when you correct the beta on the debt and all this stuff. Now, if we take this same example, and if we take our WACC, notice what I have done is I have not changed the cost of equity. But our leverage, our gearing has changed. When our gearing goes down, shouldn't we have a lower cost of equity? That's what the whole business of relevering, unlevering, Modigliani and Miller, everything since the 1958. Oh, I was born then, I'm sorry to admit that. Since that theory got the Nobel Prize, we adjust the cost of equity for the beta. It's one of the most obvious and one of the few things we really know. Now, I didn't adjust it. And when I didn't adjust the cost of equity, we take this whole cash flow, and all this one is, you should look at the formulas, it's just the net present value. Now, if you're lazy like me, if you don't have any numbers, you can just take the whole line. Let's just do this. You put equal NPV and go up to this one, and then just click on the whole line, or click on one thing and then press shift spacebar, excuse me. And then we can subtract the amount of debt we had in this capital structure over here, and then we get the equity value. And the equity value, it does go up, but it only goes up by 52. In our house example, it was supposed to go up by the change in the value of the debt, and it didn't. And the reason it didn't is because we didn't consider the fact that the cost of equity goes down when you reduce the effective leverage. Why do all these people who write these long, horrible, sorry, I hope I didn't insult anybody, these long formulas don't get this basic fact that all you are doing is reducing the interest rate. When you reduce the interest rate, you're reducing your economic leverage, you're increasing the value, or you're reducing, in this case, the value of the debt. You just have to be careful on what discount rate to use. It's not that difficult. Now, if you do it the other way, where we just kind of, this is a little more correct probably, we reduce the value of the debt, to counter that, the value of the equity goes up. So our equity has increased, just like in this thing, in this value of the house. But we didn't change the cost of equity again. So we use a higher overall discount rate, and when we use a higher discount rate, we get a value increase, but it's not the same as it should be. In fact, the answer is kind of obvious when you look at it. The answer is obvious, and the answer is that this all equity discount rate in this thing should be exactly the same as that. If you want to call that the APV, go right ahead and do it, but it's just a different kind of treatment. Should we adjust, and remember, I didn't adjust the interest rate for taxes in this one. So instead we adjust the capital structure. We can do either one. It's not that big a deal. Now, I'm going to do one more thing, and then we're going to make a second video on this. Okay. Here, now I'm going to adjust the cost of equity, and then we can see that the correct valuation occurs. And we can adjust the cost of equity in two ways. And we can use our typical WACC calculation, or this, thing where I put, so again, this is our control B, our pre-tax WACC, and this is with the, I'm going to put this the gross capital structure method. You'll see why in the next thing. Okay, and then this is going to be our net capital structure, net of tax capital. Okay, and let me, rather than kind of working through too many formulas, let me just kind of explain how this one works. This is what we started with our pre-tax WACC. I don't know what the heck that number is doing there. By the way, when you use Shift Control C, I think you know, that's one of my proudest macros. I spent so much time on an airplane doing this, so it will go to the other sheet and say where it's coming from. So we just took this from the red sheet. This just comes from the red sheets. You see that? When you press Shift Control C, you can look at that macro. I think that's a big deal. That's a real helpful one, actually, for me, to see where things come from. But I got off the subject just a little bit. Now, here was our pre-tax number that we started with, and we got 1,000. Now let's assume that the WACC, the pre-tax WACC stays the same. That's kind of like our housing example. And then we say, well, let's take the equity part of the WACC is just the total all equity cost of capital, whatever you want to call it, minus the related part to debt. Now that debt piece went down. Okay. Now once you have that, you just can divide this by the nominal cost of equity, and you get a cost of equity of Shift Control P of 5.65, and you see that went down because we have less leverage. Now when we do all of that, we do the same sort of thing. We start with our pre-tax analysis here, and in our pre-tax analysis we get the equity value of 400. Now I skip this one, and then we use the same pre-tax analysis, and I just reduce the debt by the amount of the value that the debt went up, and the value of the debt went up, I assume, it went up by 1 minus the tax rate, it went up by the tax rate. Our value of the debt went up, just like in our simple house example. This value of the debt went up. No business about pre-tax, after tax. We just take the cost of debt in the economy. That didn't change. The debt requirements, the borrowers of money who get interest in their pocket, nothing changed. Nothing changed for them. So their value, the value for us of the debt goes down by the tax rate. If the tax rate was 40%, this should have been like this. I should have done this. Okay, and now this should have still been this, and this one should have come from our other sheet. I am struggling with this for a minute. Just okay, excuse me for I just in the videos I try to do a tiny bit of Excel. It might get you irritated with me. Okay. Whoops. Okay. Now this is a constant, and if I press Shift Control C. Oh yes, this came from the other sheet. These came from the other formula, so that worked. Okay, that was kind of a waste of your time a little bit, and we're just about finished with the video. All right, now if I use that same cost of equity that I just computed in the regular old WACC calculation, now notice something crucial. I had to go to this calculation to get it. And then I do the standard kind of thing where I say, okay, let's take and this should say after tax. Okay, sorry about that. And then I take this one times the percent. Oops, oh no, why in the hell? Heck, sorry. Oh, don't yell at me. And then I take this times this one, and I get, I hope you don't stop watching my videos because you're mad at me. And then you press Alt equal. You get the new WACC. Sorry about that. I'm trying to stop this irritating swearing. Okay, and now we, again, our pre-tax, we did the same thing. We had a pre-tax cost of capital. And then we have an after-tax cost of capital. And this time when I use the WACC but subtract the 600, instead of kind of this gross method where I subtracted the after-tax cost, we get the same thing, and relative to our pre-tax case, they both increase by the amount of the debt that should have happened. And I'm stopping this video, and we're going to apply this in a second video, and I'm going to have to review it a tiny bit. Okay? Goodbye.